Hello, everybody. Welcome to our DAT IQ weekly market update. This is our update for August the 8th, 2023. This is episode 257. Can you believe that? I'm Dean Croak, market analyst here at DAT Freight and Analytics, sitting in for Ken Adamo. I'm joined this week by Melanie Patterson from Integrity Global Logistics and Team Integrity as our special guest. Good morning, Melanie. Welcome to the show.
Good morning, Dean. Thank you so much for having me. Always a pleasure to see you again.
Yeah, we've crossed paths a few times at Mid-America Truck Show and Truck and Hustle in Houston. I've seen you speak, and I've been anxious to get you on our show to talk to our audience. Tell us a little bit more about what you do.
Yeah, sure. So my name is Melanie Patterson. I'm founder, CEO of Integrity Global Logistics, which is a 3PL, and the government is one of our top customers. Also CEO and founder of Team Integrity Knowledge Center, which is a premium consulting firm where we kind of guide small businesses into aligning their business with government contracting.
That's fantastic. Well, we'll learn a little bit more about that later in the show. What we'll do now is we'll quickly get into the market update, and then we'll bring Melanie back in a little bit later to talk more about some of her experiences as a small fleet owner and some of the advice she's got for those that are looking to grow or expand their business. For those new to the program, we're here every Tuesday, 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in the freight market. Most importantly, though, we're here to answer your questions. Get those into the chat section early. We have a team working in the background to get those up to us here on the top of the show, and we'll answer those as soon as we can. We generally answer them towards the back of the show. So with that, let's start off with our weekly market update. We'll start off with our load to truck ratio and dry van. Load post volumes, and I'm going to say uncharacteristically increased in the first week of the month. They normally don't do that. They were up 3% last week. Could be some overflow from the surge in LTL volume post Yellow's demise. That could be part of it. We could be seeing some boost in line haul volumes there. Can't be 100% sure though, but they were up uncharacteristically, still down 36% year over year. Carrier equipment post dropped for the third week. That's good news. Load to truck ratio is over 3 at 3.01. It's only the third time this year the load to truck ratio has been above 3. In the refrigerated sector, higher produce volumes, again in the mid-Atlantic and West Coast regions. Fruit and veggie volumes are up in those regions. Load post volumes in the refrigerated for all temperatures, temperature settings, that is for loads, are up about 13%. Still about 37% lower than this time last year, similar to dry van. Equipment posts are down, very similar to the dry van sector. Load posts up to load to truck ratio up to 5.18. That's only the fourth time this year the load to truck ratio in refrigeration has been above 5. So some good news there on the load to truck ratio front. And in flatbed, volumes have dropped 17% in the last month, down again last week. Not unusual for flatbed volumes to be cooling off this time of the year after a very busy first half. Load posts are still about 64% lower, though, than this time last year and 34% lower than this time in 2019. Load to truck ratio up to 6.85 loads per truck. So let's have a look at a couple of markets around the country with our market condition index. To start off in Melanie's hometown in Chicago. After listing for the prior 3 weeks, dry van capacity tightened in Chicago last week. Rates are up 5 cents a mile. At $1.98, the outbound average is about 5 cents a mile lower than the state average, which is $2.03. That average for Illinois is identical to this time in 2017 and about 12 cents a mile higher in 2019. So that's the average for all outbound loads out of Illinois. One of the bigger markets in the Illinois state is Joliet. Line haul rates followed a similar trend, increasing by 5 cents a mile to $2 for outbound loads. On the benchmark lane from Chicago to Atlanta, spot rates have been rising since May, and at $1.87, they've increased by just over 20 cents a mile in 2 months, but remain 17 cents a mile lower than this time last year. A quick look at some of our top 5 markets. Line haul rates outbound in Elizabeth, New Jersey continue to increase, sitting around $1.44 a mile. Remember, folks, these are line haul rates excluding fuel. In Elizabeth, they've been increasing slightly, only up about 3 cents a mile in the last month. Atlanta, rates continue to slide, down 2 cents a mile last week to $1.65. Dallas, outbound rates flat at $1.52. That's significant. They've been dropping for the prior 3 weeks. West Coast, Los Angeles and Ontario rates fell for the 4th week. Capacity is loosening on the West Coast markets down to $1.87 and $1.96 a mile, respectively, in LA and Ontario. State average line haul rates at $2.07 per mile. They're down 10 cents a mile since the year's high of $2.17 just a month ago, and sitting around 14 cents a mile higher than this time in 2019. In the refrigerated category, at $1.88 a mile for outbound loads, capacity's been mostly flat in Philadelphia for the last 3 weeks. A lot of South American imports have been arriving there lately, but capacity's flat. On the busy lane out of Philadelphia, a lot of loads come into Philly and then head to Lakeland, Florida. It's about a 1,000-mile haul. At $2.20, Lakeland loads have been paying carriers about 70 cents a mile more than in May, although they are identical to this time last year and following the seasonal patterns. Although around 300 miles shorter, Philly to Atlanta loads have followed a similar trend at $1.94, also identical to this time last year. And for those that are interested in potatoes, the yellow potato harvest is underway in the Madison market in Wisconsin. The first potato loads being washed, graded and packed for fresh market delivery to grocers and retailers last week. Outbound loads in Madison jumped 16 cents a mile from the previous week to an outbound average of $2.53, while loads to Atlanta and Lakeland paid carriers $2.65 per load. Big West Coast market in Fresno, capacity was flat, rates leveled off at $2.21. Having a look at flatbed, after dropping for the prior 3 weeks, line haul rates in Chicago reversed course last week, up 15 cents a mile to $2.59 for outbound loads at $2.56 a mile. Joliet reported a similar trend and tightening of capacity, although on the popular regional haul to St. Louis, Missouri, rates were the lowest in 12 months at $2.63. Having a look in the southeast, in Montgomery, Alabama, rates increased by 13 cents a mile to $2.48, while next door in Mobile, rates are up 3 cents a mile to $2.39. State level rates in Alabama are sitting around $2.49 a mile for outbound loads. That's about 10 cents a mile higher than 2019. And lastly, having a look at the Pacific Northwest, capacity tightened rapidly in Medford. It's one of the biggest spot markets in the Pacific Northwest. Rates up 22 cents a mile last week to an average of $2.93. One of the busy lanes out of Medford is to Salt Lake City. That was paying carriers $2.64. That's about 23 cents a mile higher than this time last year. So wrapping up our market update with our year-over-year look at spot rates, capacity continues to loosen for the second week, even though spot market volumes have been increasing. Spot rates decreased by just over a penny per mile last week, national average sitting at $1.63. Remember, that's a line haul rate excluding fuel, $1.63. That's about 33 cents a mile lower than this time last year and just 8 cents a mile higher than 2019. The gap is closing, though. Compared to DAT's top 50 lanes, which averaged $1.97 a mile last week, the national average of $1.63 is 34 cents a mile lower. In the refrigerated market, boosted by higher volumes in the produce market in particular, line haul rates were flat last week, while the national average remained around $1.97 for the second week. Spot rates are about 32 cents a mile lower than this time last year and about 10 cents a mile higher than in 2019. And similar to dry van, that gap is getting a little bit too close for comfort. And in flatbed, that market continues to soften. Volumes are plunging. Line haul rates have dropped, now 16% lower than this time last year. After being flat for the previous week, flatbed rates dropped 5 cents a mile for the second time in the last 3 weeks. At $2 a mile, the national average flatbed spot rate is 39 cents a mile lower than in 2022 and around 9 cents a mile higher than 2019, and that gap is closing also. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, and in particular download all of the charts from today's update, they'll be published this evening on DAT's website. Just go to dat.com/market update and download the long form version of this report. And with that, it's over to the short-term forecast. So this is our short-term forecast for 35 days out. For those new to the show, the blue line here is the rolling 7-day weighted moving average of historical rates. These are for loads moved over 550 miles, excluding fuel, so line haul only. Our flagship model is RateCast. It's in all of our products. It's the green line on the chart. The red line is the short-term model, and that more heavily weights data seen in more recent weeks. And the yellow and grey lines are a mixture of the two in varying degrees and mixtures. So let's start off with dry van. This week, we're seeing more model disagreement as the dry van market continues to flatline. The short-term model in red and ratecast in green are still trying to balance recent trends with long-term seasonality. They've been doing this for the last couple of weeks. The short term in red is aligning more with our more pessimistic forecast scenario for this year, where fuel prices surge over the summer and peak season demand fails to materialize. Diesel rising 47 cents in the last 5 weeks is going to have a negative impact on the spot market, particularly in capacity. But it'll take another 4 to 8 weeks to see if marginal carriers exit the market in much higher numbers. Too early to call the impact there, but there is no signs that diesel prices are going to stop going up. That's the more alarming news for dry van carriers and I guess carriers overall. Let's go to refrigerated. This week we're seeing a disagreement with the short-term model. It's reflecting similar market conditions to dry van. Ratecast in green is taking a more optimistic view of the market, which I don't quite agree with at the moment, the way that the reefer market is panning out. I'm expecting reefer spot rates to be flat out 35 days as demand signals remain flat to down in most years. Although there is some signs that produce season is extending, running a little bit longer. There is some life in markets that normally cool off this time of the year. So we'll have to be a little bit more cautious as we look at those forecasts in the next couple of weeks to see if produce season is in fact continuing. And to end the forecast this week with flatbed, the models are pretty much in agreement, as you can see, all trending down and to the right. That reflects the softening flatbed market. But remember, it'll only take a few hurricanes to turn this market around like it did in 2017 when we had 2 Cat 5s hit the southeast. That kick-started the flatbed rate rally in 2018. We are in the middle of hurricane season. Things are calm right now, as you know, but they can heat up pretty quickly. The Gulf water is very warm. It's exactly what hurricanes need. And of course, along the Gulf Coast, that's where all of our oil refineries are located as oil prices surge and diesel prices sit around $4.24 as a national average. So I think we're in for a fairly interesting third and fourth quarter this year. All right, so that's the market update for this week. We'd like to now switch over and bring back in our guest, Melanie. One of the questions that I've sort of been thinking about in terms of our audience is how truckers get started in the industry. And working for the government is most likely not the first thing truckers think of when starting out. But you've been very successful at developing a business in this sector. So how does someone go about tapping into government work as they're starting out or maybe even well into their business?
Yeah, great question. And that's so true. When we think of transportation, we don't lead to the government as one of our direct shippers, right? And it is a thing. It is a thing. And so how do you become successful or even start with government contracting? So first and foremost, you want to lay down the infrastructure of your business. You want to make sure that you have a very well-rounded established business. So we know the government purchases anything from vanilla folders to transportation, warehousing, packaging, crating services. You want to make sure that you're niche down. You're very, very niche in regard to what you're offering the government, most importantly. And then second, you want to understand who is your end user, what are their pain points, and how you can add value to the Department of Defense, which is one of our top customers. And then, just really making sure that you cross your T's and dot your I's. Very strong back office and process and systems are key to being successful within government contracting.
So, how do people find this though? Like, obviously we could ask you to help us walk through that process. First of all, we've got to find you, but more importantly, where would someone look to see government contracts being posted?
Yeah. So not only by myself and my team at Team Integrity Knowledge Center, but there's also a ton of free tools and resources out there. And so I would advise someone who is just getting started to start out with PTAC, now known as Apex Accelerator. There are divisions in every state where they can kind of get you started, start to get you familiar with what is government contracting, the different portals to register in, but I do ask that you don't stay there. They're a tool to utilize to kind of get the wheels turning, but not for you to kind of scale and grow your business.
Right. Is there an ideal fleet size for government contracts? Or if I've got one truck, could I play in that market, or do I need to be a big player?
Ooh, great question. That's a controversial one as well. So within government contracting, we know that there's subcontracting opportunities, but they have to read the FAR and really understand what subcontracting limitations are. With that, I would advise, once again, that you have a full functioning operating company. In regard to truck size, I must tell you, Dean, the government's not going to ask you how many trucks do you have necessarily, right? The government does business to business, right? So long as you have a very sound, structured business with strategic partners, you should be fine. But I do ask that you're familiar with what you're offering the government, so you have some knowledge about running those particular trucks. If it's dump truck, if it's box trucks, whatever kind of equipment and whatever kind of service it is, I ask that you truly are operating and running. So just to kind of answer your question, there's no key truck count or truck number, as we often find on the private side. How many rooms have you been in? And the first question is, how many trucks do you have? Right? What is your fleet count? I think it's a really ego thing for sure. But within the government contracting space, Dean, it's not about how many trucks you have, but your resources, your infrastructure, and are you able to competently manage that project?
Right. And I think, I've been particularly good throughout my career at driving, owning, operating trucks. But I know for sure there is no way that I could put together or address an RFP for a government contract. I've seen some of those. So I would almost think that people could be turned off by the process, because when you go to the websites, it seems overwhelming. And we don't have a lot of time because we're busy being, in the trucking business. So what's the next step? How does someone go about that? Because it seems to me that I almost automatically have to call in a third partner like you to do this. And if I do that, does that sort of make things easier or more likely that I'll succeed?
Great question. Let's start with the word government contracting. It sounds heavy. It sounds daunting. And then we kind of start peeling back the layers, and oftentimes we get intimidated. And so I would think it would be very smart that you align yourself with a team who's well-versed in RFPs, requests for proposal, RFQs, requests for quote, how to properly package that proposal and submit a proposal that's competent and competitive. And so, yeah, I think that it would be a really great idea. For instance, at Team Integrity, we do have GovCon options to kind of really grow and scale that business and that department within your empire. And we increase your win rate by 20% by having someone who's able to do the daily contract sourcing, the analysis of the solicitation, and all that other fun stuff. So for sure, that's a great one, Dean. You're only as strong as your team within government contracting.
Right. Give us a rough idea of duration start to finish. Are we talking months or years? Or weeks?
So typically, statistically, data shows that once you enter into government contracting, it usually takes a entity anywhere between 10 to 12 months to win their first contract. Now, back to what you were just saying. How essential is it to onboard a team to help me with this, right? So if you're onboarding a team to kind of help you with the contract sourcing, the market research aspect, which is huge, right? That is going to definitely decrease that typical 12-month turnaround time to land a dedicated contract.
Right. Yeah, one of the reasons I asked that question, and in particular why I wanted to have you on our show today, was to really talk about one of the questions we get a lot, and that is, the question typically comes across, I'm a small carrier, I'm just getting started in the industry, I've got a box truck, that's where I think I'm going to start off my business. Is there a direct connection between someone starting out, say buying a smaller vehicle, and getting into the government contract space, or is that a bridge too far for someone just starting out?
Not at all, Dean. Not at all. And I think we're on to something. I've been speaking with my community at Team Integrity about this opportunity within the government contracting space. So as we know with the market, we've definitely taken a shift. We're seeing an increase in like LTL opportunities, last mile opportunities on the local level. And so within government contracting, we have something called courier services, right? And so within these different government departments and agencies, they have internal mail opportunities where you are utilizing sprinter vans, cargo vans, box trucks to take internal mail through these different federal buildings and distribute the mail to these different federal buildings. USPS is another huge mail courier opportunity within the government contracting space, which really what I want to speak to is providing your company sustainability. 2020, 2021 has showed us what to date, right? We have ups and downs within the market. And to date, we have approximately, if I'm not mistaken, on average, about 9,000 voluntary revocations. Is that so, Dean? On average, right? And
yeah, we've lost.
Yeah, go ahead.
Well, we've lost about 20,000 carriers in the last 6 months in the interstate sector. Yeah.
Those numbers are staggering to me, right? I know we had an increase in a surge of new MCs and USDOTs. For sure, but 20,000 voluntary revocations over the course of a very short time of 6 months. That's number one, people entering into transportation, thinking running off the low board is how you're going to really sustain and scale. Not so much. And so with me, let's use me as an example, right? I am truly operating a business, small fleet owner. And what saved my business? Because I too was going to be one of those 9,000 per month revocations is government contracting, right? So we're able to provide our company stability with dedicated freight. We had the pleasure to do some of our greatest works during COVID-19. We were awarded a 7-figure contract for the state of Illinois, delivering COVID-19 auxiliary supplies. So hand sanitizers, the masks, the gloves, dialysis machines, hospital beds. And we're not just getting those opportunities with our private sectors. As you know, a lot of these warehouses have closed their doors as well.
Right. Let's switch gears a little bit here and talk about the subject that you and I touched on back in June. You made a post on Instagram and it really got my attention because it's one of the questions we get a lot on our show. You leased 6 new Volvos. And your Instagram post said that didn't last long, and you cited several reasons that this could be challenging for small fleet owners. Talk us through some of those challenges.
Yeah, for sure. So as we know in business, your greatest mistakes are your greatest lessons. And starting out, entering into transportation, I knew that I did not have a very strong background in regard to the mechanics of transportation, in regard to trucking, the mechanics side of trucking and transportation. And so I was advised to take the lease model. You won't have to deal with the mechanics and the repairs and the preventative maintenance components of these very expensive units. Moving forward, went ahead and, as you alluded to, leased on 6 brand new, right off of the manufacturer floor Penske units. I was missing one component though. I did not have the consistent work to sustain at a lease cost, right? So my units that we owned outright, that we own finance, and that we leased looked very different far as our break even. And when we conduct our break even, the numbers were staggering for our leased units with Penske. And so we were drowning slowly and we just weren't able to sustain. I too, like many of the thousands of people who were entered into lease options, were like, oh my goodness, I don't have to worry about maintenance. I don't have to worry about, breakdowns on the side of the road. Show me where to sign. And so with that, I signed on the dotted line, but moving forward, I definitely would have made different options as a small fleet owner.
Right. We're in, I'm going to say precarious times. This I've said on our show a couple of times in the last few months, this could be our toughest quarter this year by far. Fourth quarter might be okay, given even if we have a non-existent peak season and demand is flat. This quarter, I think, is going to be particularly tough because diesel prices are accelerating. There's lots of global factors involved here. Heat is another big one that's causing refineries in the Gulf to slow down. We're headed into hurricane season. As a fleet owner, how do you look at the upcoming, say 6 months? What's your sense of where the market's headed?
Yeah. And so along with, your show and you providing us with the knowledge and education so we can kind of forecast what's up ahead. I think efficiency is key right now. For us, some strategies that we're implementing is, less miles, more money. Contracted freight, it's still holding on and doing fairly well versus the spot market. And so making sure that we're continuing to nurture those dedicated shippers and those relationships that we have, understanding education. It really starts with educating the team, educating the drivers, and logistics coordination, fuel stops, leveraging all of those different aspects, really crunching those numbers, Dean, to just kind of sum it up.
Yeah. I was with Adam last week, Adam Wingfield, who was our guest on our show a few weeks ago, and he was talking at the City of Life conference. I just think we, as an industry, we underestimate how important it is to know your operating costs and understand the business of being in business, not just being good at running and owning and operating a truck. A couple of questions have come in. One that I wanted to ask you, we had it on our show a few weeks ago, and it kind of follows on, I think, from your lease purchase comments. A lot of carriers have ended up with a truck that they leased or financed that is now worth a lot less than what they owe. As a fleet owner, any tips for those people in that rather precarious position?
Yeah, that's a tough one. As business owners, as executives, we have to do our due diligence when signing of these contracts. That's number one. We really do need to understand the fine print prior to signing on the dotted line. Number two, I definitely would advise renegotiation. It does not hurt to go back to the round table and see where we can renegotiate our terms on our lease contracts or our financed units. Refinancing is an option for sure, but just really holding on and crunching your numbers right now. Unfortunately, we are in a very, very soft market. It's time for us to really run our business like a business.
All right. Great advice. Refinancing and renegotiating, that's a really good option. Last question, one I've been dying to ask you for a long time. How did you go from a ER trauma practitioner for 7 years to the success story you are today?
Well, Dean, how much time do we have?
A few minutes.
So I will just kind of wrap it on up in one pretty bow. And so, I started out, first major was business management and administration. I must be honest. I was always a businesswoman by heart in the very beginning, but he had other plans for me. And I was presented with an opportunity to enter into medicine and nursing, fell in love with it. I did ER trauma for 7 years. I played that corporate game, Dean. I climbed that ladder. I got all of those acronyms behind my name, but I was left empty. I still was feeling there was more for me. And I just had small children at the time. And so I was missing Christmas mornings. As you can imagine, ER nursing is just like transportation and trucking. We're essential workers. So I essentially left one essential working position and entered into another one. And so a friend of the family knew that I was an investor, and, they were like, hey, you want to look into transportation? I said, you gotta be kidding me. Oh no, that is just too risky. I'm not going to invest in transportation and semi trucks. You gotta be crazy. Well, here I am, and we are a proud minority-owned asset-based transportation company here in the Midwest region. It was an interesting transition, but I've kind of shifted from corporate into entrepreneurship. And once again, we've been hauling essential goods for COVID-19, lab specimens, temperature-sensitive goods, and so it's very, very rewarding, and I'm happy to be here.
Good for you. It's such a success story. I love hearing about things like this. One of the questions we've got from a pretty good handle, Ghost Town Bullies, is there a site where we can see who won past government bids?
Oh, absolutely. Great question. I love that your mind is thinking ahead. And so that's one of the secrets to government contracting. It's not what you see immediately on sam.gov. It's being ahead of the ball. And so the website that you can go to is usaspending.gov, which is one great website that's hence free, where you can conduct market research and look up previously awarded contracts for that particular next codes. Who was the awardee? Who was the awarding agency? And from there, there's some steps that you need to take in regard to requesting of a FOIA, Freedom of Information Act, just to kind of get a leg up and determine when that contract is renewing. You also want to go to your state website. They always issue buying plans annually. And so they will kind of show you where the spending is going. For instance, the infrastructure bill is a huge one. I think, Dean, it's so big that we are not really paying attention to it because it's so large and we're intimidated by it. But you can now see the spending of that $1 billion infrastructure bill. And that was something that we had to be kind of ahead of. They're still spending. But yeah, great question. I love that question.
Similar question, same listener. Do I have to be a vendor for the government to win a contract?
Ooh, yeah, absolutely. So I know that we hear a lot of oftentimes we need to be registered in sam.gov. Yes, that's true. But that's for the federal level. So if we're looking to do federal government contracting, sam.gov is the very beginning stages to getting registered with the federal government. But don't forget about your state, local, and local municipalities. So your state that you're in, that you're headquartered in, register with their vendor portal. It takes about 15 to 20 minutes. Very easy, seamless process. And you can get started bidding on government contracts tomorrow on the state level. Right.
All right. Some of the other questions have come in. We'll have to, I think we'll probably have to put these on notice. Suther asks about reefer rates. Check out our weekly update that we published tonight where we've got some data there. That includes our predictions for the fall and winter. Mahalo was a regular listener. Mahalo, can you shoot us an email to askiq@dat.com? I'll get our research team to dig into what's happening in the produce market and in particular refrigerated loads in the Virginia market. I'll see if we can find anything there, including Juan Rodriguez asks about the best area for dry van. Our market condition index this week will be published this evening. Got some pretty good tips there on some of those dry van markets. So that brings us to the end of the show. A couple of shout outs before we wrap up and talk to Melanie again before we leave. Sales Chatter, I'll be on with Dan Deegan tomorrow at 11 a.m. Day-to-day Wednesday. Robert Rouse is on Landline Now on Wednesday, 7 p.m. Sirius XM, Road Dog Radio Channel 146. Same channel, I'll be on with Radio Nemo's Jimmy Mack on Thursday morning at 8 a.m. Our very own Jeff Hopper, Chief Marketing Officer, will be on with Nate and Benjamin, Freight 360 podcast this week discussing fraud. It's on this Friday. We'll be talking about what DAT is doing, in particular our dedicated site, dat.com/fraud-protection. On the Freightline podcast, Professor Chris Kaplis is talking to Seth Clevenger from Transport Topics about their long-standing Transport Topics Top 100. Don't forget, Brake Safety Week is just 2 weeks away. And with that, it's time to wrap up our show. Melanie, it's been great talking to you. Tell our viewers about how they can get in contact with you.
Yeah, for sure. So Melanie Patterson on all social media platforms. So Instagram, Facebook, LinkedIn, Integrity Global Logistics, same, as well as Team Integrity Knowledge Center, Facebook, Instagram,
Right.
LinkedIn, and we're still figuring out the TikTok.
Yeah, you and I both. All right. Well, thank you very much. It's been wonderful
Absolutely.
having you on. Yeah, wonderful
It's been a
having you.
pleasure.
Yeah. All right. Well, thank you. That's time to wrap up the show. Remember, everyone, we're here Tuesdays, 10 a.m. Eastern, giving you an update on the freight market. If you'd like to hit that subscribe button and reminder for next week's show, we have a special guest on next week. Ibrahim Bayan from Nuveen in Atlanta returns to our show to discuss the commercial warehousing market. Has the bubble burst? Have a safe and productive week, everyone.